Very happy to have John Kosar back on the show. He is the Chief Market Strategist at Asbury Research. And I will tell you, he was on the show last in October. And a few things have happened since then, not the least of which is that, well, they've launched a YouTube channel at Asbury Research. You can check out what he's doing there. He's got a video podcast going every 2 weeks. But they've also launched an RIA business, and they're managing some money. So if you want to know all the things that they're doing at Asbury Research, including all of the classic research that John is known for and has been coming on our show to talk about for years, go to asburyresearch.com. By the way, their LinkedIn, the YouTube, all that stuff, it's all linked up at the Money Life Show recent and upcoming guest page. John Kosar, it is great to have you back on Money Life.
Chuck, it's good to be here. Pretty exciting times.
So, you know, what I said was that a few things have happened since you were last on the show, which was in the middle of October. And like in my life, I got married in November. You were starting the YouTube channel and doing all the rest. But along the way, you got to November and your attitude on the market, something happened there, didn't it?
Yeah, we were looking for a bottom somewhere in the neighborhood of 4,100-ish. That was a big support level. This was back in October when you and I spoke. But our model, our CPM model, its correction protection model, that model had been risk off since August. So we were waiting for that signal to tell us that the support held at 4,100 and we were starting a new move higher. It doesn't tell you how far it's going to go or how long it's going to last, but rather it tells you that the market internals, you know, stuff like volume and market breadth and asset expansion, the internal parts that make the market go up and down, those were getting better. That was on November the 2nd, and we're still on that November 2nd risk on.
You went risk on. Market has now gotten back to where it's flirting or been at around record highs. Record highs is always an interesting time because if you're a technical analyst, suddenly you're off the charts. There is no upper limit. There is no natural level that says, here's where resistance has to be. So how high can we go? And are we going to set some new resistance level? What do you think that's going to be? Or are we going to back away from it?
Well, I've been doing this 43 years. What I do now that I didn't do before is a lot less forecasting because forecasting is guessing. I mean, forecasting is when you watch the evening news at night and you're watching the weatherman, you know, he doesn't know what the weather's going to be, on Saturday or whatever. He just, he reads his charts. So how high can we go? We've got a target in the Dow 30, which, you know, the Dow is not the market in my view anymore. The S&P 500 is, but it's got a 41,500 target in the Dow, and we're at about 39,280 now. So that means, according to this, another 5.5 or 6%, and we would still be within the realm of a target that I had since the beginning of December of last year. But what I pay attention a lot more is stuff like relative performance between stocks and bonds, volume. Volume indicates urgency to buy. When volume is good, which it is now, urgency to buy, that's fuel for the market. I watch money moving in and out of really important ETFs like QQQ, which follows the NASDAQ 100. This has been a NASDAQ-driven market, certainly since January. Stuff of that nature. So if those indicators start getting weak, I don't care where we are relative to 41,500 in the Dow, our models will go to risk off and we'll ring the cash register on the November 2nd, risk on, and we'll wait for the market to tell us what it's going to do next. I mean, it's totally data driven.
I have to say, I'm a little surprised. As you point out, the Dow, not most people's favorite indicator, yet it sounds like it is right in the middle here. How do you justify that at a time when we've got so many other indicators that people think are better?
We look at price patterns. There are standard technical analysis price patterns. And what happened to the Dow is the Dow was stuck in a range for about 3 years. Since like January of 2021, it kind of looked like a megaphone pointed the wrong way, you know, with the wide part of it on the left and the narrow part on the right. So that shows indecision over 3 years. And we broke out of that little pattern first, second week of December. And that gives me a back of the envelope indication of how high that we can go. The market goes sideways for a while, coils, it builds up energy, and then it breaks out. It expels that energy. So we're expelling that energy now. So is it something that I would, hold on to my longs until 41,500? No, absolutely. But in a world where we're making new all-time highs in the NASDAQ, we're making new all-time highs in the S&P, and like you said, there's nothing up above to hang your hat on. This is something that gives me a back of the envelope way to manage my expectations. That's all it is.
You're talking about managing expectations. Obviously, this is an election year. Election year markets tend to be benign. No matter who wins the election, we're going to have a lame duck president. Lame duck presidencies tend to not be so benign. They tend to be a little bit wonky when it comes to a lot of things. Are you kind of naturally, separate from the numbers, worried that there must be trouble coming? And sometime after the election, you'll be waiting for it to show up on the charts? I mean, I don't know if that would give you confirmation bias, right? You see something in the numbers and go, I expected this. But how do you deal with that when there's something you think might show up and you're waiting for it to show up?
That falls into the realm, for me, data-driven. There are metrics out there, including investor sentiment, how bullish people are on the market, standard deviation, how far has the market strayed away from what's normal. There's options data that we can look at to see how bullish or how bearish people are. The VIX, stuff of that nature. Right now, all of those metrics are showing that the market is about as overextended as it's been historically before you get a correction. It doesn't make me nervous or worried. It just kind of tells me where we're at. Like, you remember when there used to be shopping malls and there was that sign in the front that said, "You are here," when you walked into the mall, so you knew where all the stores were. Right now, we're at that historic place that the market historically moves back to the mean. It moves the other way. But it is not a sell signal. It's a symptom. It's not a signal. What's the signal going to be is when our Asbury 6 metric, which you can find out about that on our website, but it's basically 6 different indicators that measure the daily internal strength of the market. When those indicators turn negative or they turn red, that's going to tell me that symptom is now becoming a signal. And that's when we'll start to move money out of the market and hope to get a nice correction and then redeploy that money, ideally 10, 12, 15% underneath the place that we sold it. And that's the best and fastest way to increase the value of your portfolio, is avoiding the move down or some of the move down and then reapplying those assets after you've had a correction. That's what we look to do.
Let's also talk a little bit here about the assets you're using. Here we are, you're risk on, but is that risk on only with the market? Are you looking into commodities? Are you looking into certain sectors? I mean, how do you decide and what are the things you're looking at right now?
When I talk risk on, risk off, I'm talking about the stock market. I'm talking about equities. Then we have other models that tell us where in equities to be. We've got a sector rotational model. It's called SEAF, is an acronym, SEAF, for sector ETF asset flows. So we're tracking the money moving around the various sectors. And right now, the money is moving into energy and it's moving into industrials. And there's a parallel there because some of the other data-driven stuff we look at, like where's the money going, what's outperforming. For the past 3 or 4 weeks, we've been in the oil markets, crude oil that is. We've been in copper, in lumber. And what we're seeing is something we haven't seen in a long time. It looks like we might be in the early stages of a bull market in commodities. We're in gold miners as well, copper miners. We're watching the grains. Is that something we do all the time? No, we're an equities firm and we manage money in equities, in stocks. But it's particularly interesting now because people have been wringing their hands about inflation for a couple of years. And there's more to inflation than just the price of commodities. But right now, it looks like we might be in the early stages of a rally in commodity prices, which means stuff's going to get more expensive.
Stuff's going to get more expensive. Can you define that a little more for us?
Well, price inflation, when it costs more to buy things, It usually means that there's money chasing the price of goods, right? There's more money chasing the price of goods. And what typically happens during an inflationary period, if this, and again, I'm involved in a dozen different commodities. I named several of them for you. If this thing lasts for another 2 months and we see evidence that it's over, we ring the cash register and we kind of re-rack and see where the next place is that provides opportunity for us. But if this is the start of a period where the price of goods goes up for an extended period, that is typically accompanied by or followed by rising interest rates, where the economy starts to heat up too much and the Fed starts to raise rates to cool it off and to keep the prices of goods from going through the roof. So I'm not a forecaster, I'm a data reader, but should we get an extended period of rising commodity prices, that could be the inflationary fears that people have been having for a couple of years. And if the Fed needs to throw a wet blanket on that, they do it by raising rates.
It puts us in that spot that everybody's watching and waiting to see how it'll play out. We appreciate reading the data for us, John. Thanks so much for joining me on the show. We'll talk to you again in the not too distant future.
Chuck, it was great to talk to you. See you soon.
That's John Kosar. He's Chief Market Strategist at Asbury Research, which is online at asburyresearch.com. They have their new YouTube channel. We've got the long link for it on our guest page. And again, they're in the RIA business now, so you can go to asburyresearch.com to learn more about that as well.